Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. As everybody settles into their post-Labor Day routines, it's a good time for investors to reflect on market conditions and review their financial plans for the rest of the year. Despite some market volatility during the summer, major U.S. stock indices have all experienced significant gains this year. Bond markets have also improved, with various bond indices posting gains year to date. A softening labor market and slowing inflation point to the first Fed cut later this month, and shifts in the Treasury yield curve may help stave off recession expectations. All in all, the past few months are a reminder not to overreact to short-term market moves. This could be an important lesson in the coming months with the presidential election approaching with ongoing geopolitical risks. First, this chart shows annual returns for the S&P 500 represented by the blue bars and Bloomberg U.S. aggregate total returns in gold. Major stock indices, including the S&P 500, have shown significant gains this year despite market volatility. This has occurred even though many expected a hard landing as the Fed raised rates. So far, there have been two periods of sustained pullback this year, in April and in August. But both instances experienced sudden market rebounds. Bond markets have also improved, showing positive returns year to date, after struggling for much of the year as rates remained high. Expectations of an imminent rate cut have helped to boost returns. Next, this chart tracks the federal funds rate, with the dotted lines indicating the FOMC's projections for rates based on the summary of the economic projections they publish quarterly. With inflation now down to 2.5% in the latest PCE price index report, the Fed is now expected to issue its first rate cut in September. This is a reversal of the rapid rate hikes from early 2022 to July of 2023. Recent jobs data showed signs of softening, with unemployment rising to 4.3%, prompting the Fed to shift its focus from inflation to labor market concerns. So, with inflation improving, the Fed is preparing to cut rates to ensure that the economy continues to stay on track. Many of this year's market swings have been the result of shifting expectations around the Fed. It's important to remember that investors believed that the Fed would cut several times at the start of this year. Then, when inflation ran hotter than expected for a few months, investors believed that the Fed wouldn't cut rates at all this year. Now, expectations have shifted once again. This is a clear reminder that markets can get ahead of themselves, and it's important not to get swept up in the latest market move. Finally, this chart shows the Treasury yield curve at 3 points in time: the latest market day, the end of the previous quarter, and the end of the previous year. It shows that the yield curve is no longer inverted as market-based interest rates adjust to approaching Fed rate cuts, with yields moving lower, especially on the short end. While yield curve inversions historically precede recessions, this time could be different as higher short-term yields resulted from inflation shocks rather than from Fed over-tightening. Lower rates could be positive for economic growth, especially in rate-sensitive areas. We hope you found these insights helpful. If you have any questions, please don't hesitate to reach out. We look forward to hearing from you soon.